Welcome to Upthinking Finance, a podcast that offers a unique and discerning view of economics and financial planning. Here is your host, Emerson Fersch.
Welcome to another episode of Upthinking Finance. For the first time, I'm quoting today's guest to start the episode, and in referring to the critical nature of risk management in the moments immediately preceding and immediately following retirement, our guest today said large losses in that period have permanent structural impediments to your lifestyle. And that was episode 41 of this podcast, and that was from our guest today, Mike Philbrick, who's the Chief Executive Officer of Revolve Asset Management. He's a co-manager of the Return Stack Balance Allocation and Systematic Macro Fund. And for me, one of the biggest things he's accomplished is a co-author of the book Adaptive Asset Allocation, which my business partner Amy and I consider foundational to our investment strategy and what we do. So Mike, joining us from the Cayman Islands, welcome back.
Well, it's great to be here. Glad you read the book. It's been 10 years since we wrote that.
You know, I'm in my Montana office right now, so we have the weather extremes, but I wish it's in my office in Utah, and I wish I had it because it's one of those books that I've completely destroyed with sticky notes, folds, Post-its, all of it, So anyway, no, it's great. And so I guess that's a good place to start because in the book, I remember there was kind of a basic thesis, I guess you could say, my words, that your concern, you and your partners, and I guess that of the company, was this idea that the next 30 years we're going to assume that the next 30 years we're going to look like the last 30 could be problematic. And now that we're about 10 years from that insight, has it changed? Where do you sit with that?
I think it's actually proven out to be, quite prescient when you think about the previous to that, and you think about 1982 to 2022, right? Those 40 years where we had powerful tailwinds from falling interest rates, disinflation, globalization, expanding profit margins. And so the traditional stock bond portfolio performs really well in that environment. And when you have falling interest rates, you tend to have that yin and yang between stocks and bonds. And that 60-40 portfolio gets a lot of dampening from the bond side of the equation, as bonds tend to rally when you get growth shocks. But when we think about 21, 22, 23, and we think about when we started increasing interest rates and went through an interest rate hiking cycle, we saw those stocks and bonds correlate, and we saw some of the largest declines in balanced portfolios that had ever been seen. And since then, we've seen bonds in a 5-year bear market. And so if you were of the mind that I was going to build a portfolio based on the last 40 years in 2022, the timing there would have been particularly prescient, right? You would have found that, okay, we're now in an interest rate cycle that's rising. We actually have deglobalization happening, rising interest rates. And now the good thing is that we've had, exceptional growth, and then we have this new AI thing that's sort of really increasing productivity and is an engine of growth. But again, bonds aren't doing what they have done over the last 40 years if we look previous to 2022. And so when you have that combination of inflation reemerging, stocks and bonds declining together, greater geopolitical fragmentation, fiscal deficits continue to explode higher, more volatility in supply chains, more volatility in inflation. So there's inflation and then there's the volatility of the inflation. And you think about that and you say, okay, wow, if I had been just building my portfolio based on the previous 40 years, I've got some blind spots, right? It's not that the old portfolio is wrong. It just was built in a world where that may not be the case anymore.
Yeah, my simple brain, and you kind of laid it out really well, is that you're right, the 40-year tailwind of declining interest rates and inflation. And so even now, and I should probably know this off the top, but the 10-year treasury is somewhere between 4.25 and 4.5, I think. And so even if we were, there's just not a lot of runway there to go back to zero. So it seems to me just logically, you have to think that moving ahead, things are going to change. Now, with our clients, we've embrace this idea that this time is different, in the sense of everything you've talked about. And, that can be a dangerous statement. I don't know if are you familiar with Jeremy Grantham with GMO funds?
Yeah, of course.
So he just wrote a book, which is actually really good. It's up on the par with you. There's few that I really just consider foundational for me that I rely on to just perspective. But he made kind of the comment, and I'm paraphrasing, that, kind of career risk, he calls it, that it's better to fail with the group than succeed on your own. And so, and I think you guys have done that as a company. I mean, you're blazing a different trail. The message that equity returns going forward may not necessarily, be what they were. You're not predicting. I remember from our conversation before, you're not predicting this fall off a cliff, but the idea that returns could be muted over a longer period of time relative to what they've been. That's. I mean, I get social media stuff all the time, and the usual companies are still pushing the same old approach to things. Um, I guess maybe I'd ask you, because this leads into what you're doing and kind of what I see as your guys' mission, but how this evolves into broadening your mind in terms of what you're doing with assets as an investor.
Right. And let's think about 2008. What was the largest company in the S&P 500 in 2008? Do you remember?
Oh, I'm going to guess it was a financial one, but I could be wrong.
Close. Remember, we were going through a resource boom.
Oh, okay, that's right.
And then think oil and gas, and then you come to the conclusion of Exxon.
Oh, Exxon, right. Okay, yes.
Exxon was the largest company. It's now ranked number 14, and the entire energy sector of hydrocarbons is 3.5% of the S&P 500. So I guess I mentioned that because diversification is an explicit recognition that you may not know the future or that you don't know the future. And so you have to think about diversification through a myriad of potential economic cycles that can manifest. And so if we think about the two dynamics that really impact asset prices, there's three. There's a liquidity dynamic that's there, but let's keep it simple. We've either got inflation that is rising or falling, and we have growth, which is either slowing or accelerating. And if you think about the period from, sort of 2012 to 2020, we had a disinflationary boom. Inflation's following and attenuating while we have accelerating growth. Well, US equities do really great in that environment. Bonds actually do pretty good in that environment too. Commodities suffer mightily, gold suffers, and even some active strategies like trend following, they do positive returns, but they pale in comparison to what's going to be your benchmark. Contrast that to an inflationary stagflation type environment like we had from 21 to 23, where bonds were down 40%, equities were down 12%, gold was up because it's an inflationary hedge. Commodities were up about 21%, again, inflationary hedge. And those managed future strategies and trend following were also up. And then you get other areas like rising inflation and accelerating growth. Probably where we are today, if we think back to 2001 to 2008, if we remember the BRICS, Brazil, Russia, India, China, developed market stocks did okay, but emerging market stocks did fantastic, and they were tied to commodity prices. And so commodities did really well, gold did really well, bonds did okay, nothing great, but developed stocks, really, if you remember 2000 to 2008, I mean, you got, a 50% decline and kind of zero returns in the middle of that. And so again, we don't know what the future holds. So how are we going to build some robustness into the portfolio in order to prepare ourselves for the times that are differentiated? And if you think about the S&P's construction today, remember we go back to 2008, we see Exxon as the top stock. We now have, the 6 or 7 of the stocks that are, sort of 30% of the index. We have that index that is broadly, it's a technology index. And so what are the blind spots to that? Well, you have de minimis exposure to natural resources, to the physical side of the economy. And if we're going to build out the growth engine of those technology stocks, which seems to be more and more related to something with AI, you're going to need physical manifestation. The previous ones we've had have been built on software, and software scales at an S curve of technology. There's very little impediment to Microsoft selling more more of their Microsoft suite of products. It's just code. But AI is about inference, and inference needs electricity, and electricity needs a lot of the commodities that are underlying the economy, and the S&P has a blind spot. It doesn't have a lot of those opportunities in it, and that's just a function of its market capitalization. So if you think through, well, if we are in an inflationary regime and it's inflationary growth, okay, well, those companies can grow. You've got a great technology growth engine, but what are the other areas that could be growing? If you look at emerging markets, they are double the performance of the S&P 500 over the last year. If you look at certain commodity areas, again, the same sort of thing. So again, what you want in your portfolio is the ability to diversify across these asset classes, which span these different regimes, whether you have rising inflation or falling inflation, or whether you have growth or lack of growth. Now, how you do that is where the ideology of return stacking comes in.
Okay, you bringing up, these are really good points that are helpful for people. One is, I was going to ask you, maybe you could just explain for people and understand how the market capitalization impact, because it's a really good point. I like the idea of blind spots. That explains it perfectly, because I think the average person thinks they're plowing their money into an index fund, they're getting equal exposure across sectors, across the companies and all that, and it's not like that at all. Do you mind, just for the novice?
Yeah, think about, so the market capitalization weight of the S&P is just basically how big is the company, and the stock price times the float, and the bigger these companies become, the larger they become in the index. Now, I'm Canadian, crazy as that sounds, and if I go to Canada and I look at our index, the TSX index, now much smaller, index. Canada is much smaller than the US, but our index is about 70% exposed to, industrials, natural resources. We are rocks, trees, oil, and gas. That's what Canada is. So now we have this index, and we're like, okay, let's buy an index because I'm going to be diversified and I'm going to track this benchmark. That's a great thought initially, but what does that index have underlying it? And what are the exposures across the sectors? And those sector exposures give you some of those exposures across those areas that we talked about, those four quadrants formed by inflation and growth. There's those four quadrants. We talked about inflationary growth, 2000 to 2008, where we had a boom in natural resources. Well, those economies outperform. Those economies that have heavy weightings to those outperform. Canada is outperforming the United States over the last year. Emerging markets are substantially outperforming the US over the last year. They're outperforming because they have substantial allocations to commodities. They are economies that are long oil and gas, they're long copper, they're long silver. They're producing them and selling them, and as those prices go up, those economies do better. Well, think about that in the context of your portfolio. If you're only in the S&P 500, you have a very tech-heavy index that you're relying on for future growth in your portfolio. Now, my point is not to say abandon this beautiful growth engine that is S&P, the innovation that happens in the US. That's not the point at all. The point is to simply look at that and say, what are the blind spots that I have from a diversification opportunity that I can fill in case some of these other things manifest, in case we get inflation that stifles growth, in case we get monetary debasement that continues. We had a run in gold over the last couple of years. We're having consolidation in gold. Well, gold provides protection from monetary debasement and geopolitical uncertainty. And we have no shortage of that going around at the moment. And so you want to make sure you have things in your portfolio that are built around making sure they have sensitivities to the other regimes, not just the one that you're in now, or the one that you may have been in for the last 10 or 15 or 20 years, because you don't know when these other regimes are going to manifest. And tracking an index is fine. The next question is, what are the predispositions? What are the tilts in the index that I am exposing my portfolio to? And where are the blind spots? Where are the things that it's not going to respond to? If oil goes to $300, the S&P has 3% in oil and gas. There's going to be a de minimis amount of upside opportunity that's included in that index just by its construction. Now, we know that over time that changes, because from 2000 to 2008, Exxon wasn't the number one stock in 2000, right? It became the number one stock because we went through a massive move in those energy prices.
You bring up, that's a great point. Thank you for explaining that. I mean, even I was just thinking 2022, you mentioned before, one of those sectors, which I guess now would be almost considered an ancillary play to the AI move, which is MLP infrastructure, the midstream space in energy, which in 2022 and even of late has proven to be it's not correlated directly to S&P. And so you're getting this in a sector that I don't know how it's the one area I think if I were to say, okay, I know this pretty well, that's the one, only because I started showing it to clients in 2014 and it literally just cratered 60 to 65% from that point to the bottom of COVID. And of course, since then, but so I've seen the good, bad, and the ugly with that. But it's that same idea. So which leads me to a question which I didn't think to ask, but I'm just curious if you can, because I know you've got others that are more on the front lines. But what kind of resistance do you run into with just these kind of ideas? And I ask because I have a friend who actually met your associate Rodrigo, your partner, one of your partners, probably 2 years ago, gentleman in Monaco who he runs a trend model algorithm that we use the data for. And he just mentioned, I mean, trend following as a strategy. I mean, it's my words, but it's kind of considered voodoo. It's just not embraced as viable strategy. And there's probably self-serving reasons like you cut out any kind of subjective, forecasting and economists, you're removing a lot of salaries just to follow a model, right? But I mean, is that a fair question on your side? Just kind of do you run into philosophical differences in your circles?
Oh, I think always. There are many ways to go about building a portfolio that will accomplish the diversification that you need. So, it's not that they're right or wrong; they're just different. The one thing that a managed futures strategy has to its benefit from a trend following perspective is that you're looking at four major groups of asset classes. So you're looking at stocks, but not just US stocks. You're looking at stocks in Canada, stocks in Australia, stocks in the UK, stocks in France. So you've got global stocks. You've also got global bonds, not just US bonds. And then you've got commodities and currencies. So you have these four major areas. And because you're in the managed future space, you can be long or short those areas. And you can do that very easily and very efficiently. Now, what that does is it really broadens the diversification in a traditional portfolio. That's the first thing, because you've got exposure to all of the other asset classes, all the other equity markets, bond markets, commodities, currency markets that you don't necessarily have if you're a US investor or even if you're a Canadian investor. Now, the next thing is because it can be short, it has the propensity to provide returns in really difficult periods. And so, the returns were quite positive in the 2000 tech crash. They were quite, sort of, I think 60% back then, 30% in the 2008 great financial crisis, and up about 40% in the 21-22 inflationary bust. And so the reason they were able to accomplish those returns is because they can be short those asset classes. And so they help fill out the diversification of a portfolio quite handsomely. And they also have this benefit of providing returns to a portfolio that can be rebalanced when there's blood in the street. You hear this, buy when there's blood in the street and be fully invested. So those two pieces of advice I always get confused by, because how do I be fully invested but then have cash to buy when there's blood in the streets? What you want to have is portfolios that actually are producing returns in those times so you can actually accomplish that task. So that's the first thing. Now, there's always a yin to the yang, right? The idea that, okay, this sounds great, it must do great all the time. And the reality is they go through the same they have drawdowns, managed futures portfolios and trend following. They go through low return periods. And that's the frustration, the tracking error that comes with them. And most investors, if you ask them, what's your experience like in managed futures? They all are just, they shake their head and they bow their head, and it's just terrible because they end up buying it not in 2008, not before the crisis, they buy it after the crisis. And so that is the ideology of return stacking, is let's put the diversifier on top of the beta. So S&P 500, your beta, great. We're going to put managed futures on top of it, because there are times, and they're quite long periods of times, when managed futures, they don't have large negative returns. They just don't have returns. So, if you think about the period from 2009 to 2020, that's a 10-year period where managed futures kind of did nothing. And if you think about that in your portfolio, okay, I was doing a 60-40, and I sold 20% of my portfolio. I took 10% from bonds, 10% from stocks, and I'm running a 60-40-20. That classic diversifier. I'm going to have some alts over here. If you put 20% in managed futures alts, they didn't do anything. They had years where they're up 5, then they're down 5. Then they're up 10, then they're down 10. They just middled around. The problem was that you funded it with assets that were doing really good. You sold stocks and bonds, and over that period, those stocks and bonds were returning 8, 9, 10%. And so you were doing diversification via subtraction. And that's where the behavioral dirt gets into the gears, and it clogs the thinking, and it causes people to say, why am I hauling this albatross in my portfolio for 5, 10, 15, 20% of whatever it is? It's the opportunity cost. It's the fact that you could have been in those stocks and bonds. And the client makes no bones about putting that pressure back on the advisor and saying, why do I hold this piece of dirt that is holding back my portfolio? It's been 5, 6, 7 years and it's done nothing. And the advisor is saying it's there for when we have a rainy day. It's there to complete or to fill out the portfolio. It's there to provide diversification. This is where people say diversification is a free lunch. It's not a free lunch. It is a well-earned behavioral lunch, because you will experience drag. You're always going to have something in your portfolio that's killing it, and you're always going to have something in your portfolio that's killing you. And if you've got something in your portfolio that's killing you, you've got some diversification happening. Now, how you structure the diversification is where I think we've come up with something very novel in return stacking, which brings that institutional portfolio management system called Portable Alpha, and it makes it available to individual investors and advisors to impart to portfolios on their clients' behalf in order to help attenuate some of these blind spots that we experience and some of the behavioral challenges with actually putting diversifiers in your portfolio.
So yeah, you brought up some good points, and I guess the thing is you mentioned explaining to people the role, and that sounds real easy, but it really, this is where I think again, and I'm not trying to sound like I'm more smarter than anybody else, but I think if you're really, there's advisors are working, and I had a wholesaler with actually the gentleman with the company that does all the MLP stuff, that we use quite a bit. He mentioned, because I asked him, I go, you guys don't, the fund has killed it. That sector has just been,
it's a fantastic.
Yeah, it's been, and that on top of with a high dividend distribution rate on top of it, and it's been spectacular for clients. And I asked him, I go, why didn't you talk about this? Why, because they don't advertise it. They have all these other, and they just stay away from it. He said, he told me once, he goes, it's because most advisors don't want to have to explain, the bad performance, the history, like you brought up of commodities. If you go back to like the 2010 decade, pretty much, dead money. I had a client look back, it was, why are you recommending this? He looked at the fact sheet, and I said, well, I go, because if, you can look back through the rearview window, we're looking forward to the head, the windshield, so to speak. And, but that's work. And it's when you focus on that behavioral, which is a really good point. People, and I even had to get there myself with this stuff. You have to get the proverbial people, investors need to get comfortable with the idea that there is going to be a portion of the portfolio that is literally lagging, that's there for different reasons. And that's just like an acquired taste. It's work. And so, Amy and I find ourselves, when we sit down with clients, constantly reviewing, the whys behind these types of exposures. Now, I will say it, I know we're not supposed to get into specifics, but with, the fund, the main fund you run that we use, it sounds like it gets absorbed into this strategy where it's not, this
80% in this 20, it's all boom, 100%. But in the end, is that a fair way to put it?
Yeah, I think we use the term cloaking.
Cloak. Okay, sorry.
Right. So when you take, you have a dollar of a base portfolio, and so you've got that dollar, whether it's stocks or bonds or stocks and bonds, then you stack the managed futures portfolio on top. What that does is it allows for the individual investor to not do or not pursue diversification via subtraction, but rather do it via addition. Don't sell the assets that you know, love, and trust. Don't sell the assets that your tracking error is going to make you predisposed to doubting when they have long periods of low performance. Stack those diversifiers on top of the things that you know, love, and trust. That way you get what you wanted. You're not funding it by selling stocks and bonds that have produced pretty good returns over the long haul. So you're not having that competition. Rather, just stack it on top so that those excess returns are there when you need them. And then we do all the rebalancing and whatnot. But that also allows you to, in the context of when there's a bear market and stocks and bonds are having a difficult time, you've got something in the portfolio that's doing well, and you're constantly rebalancing back to those things you're buying when there's blood in the streets, if you will. So you get this automatic rebalancing that happens going on in the portfolio, as well as cloaking these alternatives. And I say cloaking, really it's stacking them. And so that when you have those periods that we talked about from 2009 to 2021, where they're not doing anything, well, you're getting the returns from that either stock, bond, or stock and bond portfolio that you've got as your main driver. And so they're suffering. They're adding a percentage point, they're taking it away. And then you come into a year like 2021, 22, where you have that inflationary spike, and all of a sudden you've got something in the portfolio that's providing those returns whilst the balanced portfolio is struggling, or while stocks or bonds are struggling. That helps the client stay the course. Rather than buying the diversifier, having it go through a long period of low returns or a drawdown, selling it, crystallizing those losses, and never having the opportunity to gain those returns back, rather than doing that, let's stack it on top. Let's let it do what it does. And in those critical moments when we need it, it's there.
No, that makes actually perfect sense. Now, I don't know if you're allowed to drill into this more, because there was a time when I remember when I think we met with Richard, works with you guys, and he's great. He kind of explained that, if you drill down a layer, I guess, into the allocation there, because you're bringing up things that I don't think a lot of people, and maybe even advisors, don't think about, the layers to diversification, which is beyond just, asset classes, and even the basic three: stocks, bonds, and cash. I mean, that almost seems irresponsible, in my opinion. That's my words at this point. Because you talk about fiduciary responsibility, and you mentioned before, when you start opening up the short side of the market, I mean, a light bulb went on in my head, because I was the guy, 08, 09. What's your response to somebody when their portfolio is down 25 or 30%? You got to write it out. You got to write it out. That was pretty much all I had. And maybe, a couple of, insurance products that had some guarantees built in, but that was it. That was risk management, in the retail side for most people like me, dealing with, I guess you'd say, more moderate type investors, that had limited means, and, there's only so much you can do. But when you talk about opening up the short side, now all of a sudden that's a diversification that it doesn't enter in the asset class. That's a whole different, I mean, to me, that's just like it's like you've gone through the window and now you're on the other side, and a whole bunch of possibilities get there. Why wouldn't you do that? So I think that's a really good way for people to realize that diversification goes pretty far and deep beyond just kind of what we normally see represented. But the portfolio, there's, if I recall, there's a trend following component, there's a momentum component, there's a tailwind component. Is it fair for me to ask you to maybe just dissect those a little in basic terms, so people kind of get, that it's more than just, a stock, adding some commodities into a mix and a model that shifts the exposure? Because there's a lot more going on in there, which is comforting.
Yeah, absolutely. So when we think through the idea of building that portfolio of managed futures, as I said before, They do respond well in these really critical periods like 2000, 2002, 2007, 2009, 21, 22. And a lot of that performance does come from being short. And some of it has come from being long the correct asset class too, being long bonds because you're in a growth shock and bonds were going up. Being long commodities and gold in 21, 22 because they were going up. It wasn't bonds or stocks. They were both down. So you want to be able to be in the right area. So first of all, it's the flexibility around that. And remember, we've got stocks, bonds, commodities, and currencies. So we've got a much broader set of over 65 different asset classes in the fund to look at. And then what we do is say, okay, well, trend following is great. It's actually lovely. Buy more what's going up, continues to go up, hold it. If something's going down, sell it. And if it continues to go down, stay short. But there are other factors you can harness as well. Things like carry. So carry is another factor, which is what's the rent we're being paid. So, in many futures contracts, there's a term, well, in all futures contracts, there's a term structure. And as that term goes to the actual spot price, there's a carry that you are paid or that you have to pay to own that asset. So in the carry sense, what you're looking at is higher yields, all things being equal, means I'm going to collect that rent. And usually what happens in carry actually is you get, sort of yields that are quite attractive, and then they get a little wider, and then they get a little wider, and then all of a sudden they collapse. But it's just a different factor, different way to build a portfolio. So you're thinking first trend, is the trend up or down? Should I be long or short? Next is carry. Am I getting paid high rent, or am I having to pay high rent to hold this position? So if I have to pay high rent, it's not going to be in the carry portfolio. But if I'm accumulating high rent, whether I'm short or long, both of those can happen, then I'm gonna have those positions. Mean reversion in a shorter term, are we really extended? Is there an opportunity for prices to return to their average? Seasonality, right? There's a definite seasonality. Everyone's heard the old sell in May and go away. Didn't work this year, that's for sure, in the stock context. But remember, each of the 65 contracts have slightly different seasonality. Gold has a different seasonality than stocks. The agricultural commodities, they definitely have some seasonality, as does natural gas. So there's those seasonality factors to take advantage of. Then you've got relative value. So when you're comparing asset mispricings, how much energy is created by a barrel of oil versus a MCF of natural gas, or how much is the downstream petroleum refinement costing? Where are those gaps? And all of these things are done systematically. So skewness is a funny sort of tail risk compensation that you can get, and so all of those factors are combined into the signal creation. So think about it this way: if you're a trend follower and your asset is sunscreen, and you're in North America, well, sunscreen sales, they start to pick up in May. They really hit their stride in July. In August, the trend is amazing. Your system is telling you to get long as much sunscreen as you possibly can. Well, okay, that's your trend follower. What's your seasonality? What is your seasonality factor saying about buying sunscreen post Labor Day? It's saying, no. We've got some seasonality impacts here. So you might want to attenuate the strength that you have in your trend model because of the signals that we're getting in the seasonality side of things. So think about that across those 6 different factors. And when you're viewing the commodity matrix, these 65 different asset classes and contracts, and looking at putting them through the filter of those 6 different factors, how strong is the signal? Do I have strong trend? Yes. Oh, I've got strong carry too. Oh, great. We're in a good seasonality period. Wonderful. We just had a mean revision period. Great. All of those things are going to stack up to say we need we think that there's a larger signal coming from that, thus a bigger position size that we would have. So we're looking at that investment universe of all of those commodities: agricultural, energy, forex, metals, rates, bonds, equities, and we're looking at them through those 6 lenses, and we're looking how much this just improves the signal, improves the prediction value of where the asset may go. And you mentioned something a little earlier too about the research and doing the fundamental side and all those things. What we find is the trend comes first, the research rationalization comes later. Most oftentimes, the trend has initiated itself before the research is suggesting it will do so. So we find price is a pretty good indicator of where the narrative will be in the future. There'll be some narrative made up. There'll be some research reports made up about why there's a shortage in natural gas, or why there's a shortage in corn, or why French stocks are better than U.S. stocks. But it often happens after the price narrative, after the price is actually showing you that. So rather than wait for the research or speculate on the research, right? Someone writes a research piece and you look at the price and there's no proof that research piece or that opinion has garnered broad adoption. So pay attention to the price, pay attention to factors that are academically backed and that can harness these excess returns inside of the managed futures side of the portfolio.
Listening.
That was a lot. That was a lot of,
No, but you listen to it, even anybody who doesn't, know, some of these terms they may not be familiar with, Forex for currencies, but the reality of it is it just, you listen and it's like, why wouldn't, you're just opening up more options. You're opening up more options. And to me, I'm not, like I said, I've learned, we all learn lessons. You spend enough time in this industry. And one of them for me is maintaining flexibility. That is, I've learned by far, probably one of the biggest things you want to do, in not locking yourself into something, that speaks to liquidity, but just, again, a mindset or a bias. And I like how you explained that, because that is, I think if there's been anything freeing for me, as my eyes have opened in the last 6 years towards new ideas, it's this idea that I don't need to have those answers. Somebody asked Amy or I, what do you think is going to happen? Well, I can offer an opinion, but am I going to base somebody's retirement on what I think? I know, I subscribe to certain people, I read different things, I listen, but that's information. So you can certainly be aware of things, but that I'm not going to make a bet on somebody's future because of something I think. And so I really think that's a valid point, that, the trend or the move or the direction is well on its way, before. And I've had people, we run into this is, if you look for signs where somebody's about ready to ring the bell, you're at the peak. I don't think it ever happens, but I know from my past, you start to hear, clients. I had one gentleman, years ago, I remember, right in the middle of the .com, I'm suggesting, bonds for some risk reduction. Why would I go get 6% here when I can get 30% over here? And I remember thinking, how do you can't reason with that? And that's starts creeping up here and there. You start to see those little signs of people are forgetting the other side of how this could potentially go. But anyway, no, that was a great explanation. And I guess the last thing I'd say is, which kind of aligns with the conversation is, what do you think the biggest headwinds, risks are to investors as we go forward, particularly those people who are, say, within a 10-year window of retiring?
Well, I think one of the biggest things is there's a couple. One is this regime looks different to me. If you look at interest rates, it's a rising interest rate environment, and we're going from, there was going to be cuts to now potentially we have more increases coming. And so it's not your grandfather's market of 1982 to 2022. It's different. So there's a different regime, and a different regime will call for different solutions. Now, the challenge is that if you've been around for a long time, and you've been a restaurant that's been around for a long time, you're biased. You're biased by your own experiences. You're biased by your own history. And so that's one of the challenges. And the next is the behavioral challenge of actually trying to get those diversifiers into the portfolio so that you can stick with them. That's probably the biggest challenge. Just like you've alluded to, we have stock markets making new highs. There's growth. That's great. And I'm not saying abandon the growth side of the equation. Not at all. What you have is other opportunities for growth that are outside of technology as a US investor that are doing really well. In fact, they're doing better than your own home market. And so how are you harnessing those returns in order to use diversification to not only reduce risk, but actually to enhance returns? And so when you have a market that is broadly dominated by technology, that blind spot is also an opportunity. And I'm not saying at all that you should sell that growth engine that is the S&P 500. Keep it, but stack it. Stack these other diversifiers, these things that are providing excess returns on top of your portfolios. Stack them on top of what you're doing in your stocks and bonds. That way, that'll help attenuate the behavioral side, right? So you're getting some excess returns from managed futures portfolios. That's great. Love that. Everyone likes that. But eventually, there will be a drawdown. There always is. The year 2000 was followed by 14 years of zero returns and 250% drawdowns. People seem to forget that. Now, I'm not ringing the bell saying this is the year 2000. We've got high valuations and all that fun stuff, and you can read Grantham and all those guys, and they're going to tell you forward returns look pretty bleak. But that doesn't mean that current returns can't go a lot higher. And so that tracking error is what you have. We don't really manage as advisors. You don't really manage stocks, bonds, and cash and manage futures portfolio. You manage human behavior.
Amen.
And you've got to take the steps to manage those emotions today to try and attenuate what's going to come down the track. And I don't know if this bull market has 2 years in it, 5 years left in it. Who knows? It's not infinity. And at some point, there's
It is an infinity. That was a good one. Thank you.
So at some point, that we'll have a correction and we'll have a bear market, and that'll set the stage for the next bull market. But wouldn't it be nice to have something in the portfolio that's doing well at that time to offset some of those losses? And remember, we're talking about, let's come back to the financial planning side of it. We're talking about real world individuals who are spending a portion of this asset. They're spending down this capital. And when you're in decumulation, drawdowns matter more, right? If we go back to the 2000 scenario, we could have a drawdown of 30% 1 year. Okay, great. Maybe you get a V recovery, whatever. You got your new reality. In the tech crash, it was down 10, down 11, down 9, 3 years in a row. So you're down 30 some percent, each year down 10, and you were withdrawing money. Time was going by where you needed to fund your retirement. And so when you get into those longer drawdowns, what you look at is a portfolio that, even if you're taking 4%, like they say, you had 45 cents left on the dollar by the time 2003 left over, it came around, if you had the fortitude to hang on that long. And so what we're trying to do is build in other assets, in particular at these times where we have, these large spikes and high valuations. How can we help fill the portfolio blind spots? And this is where return stacking becomes a really interesting opportunity, because you're not giving up those drivers of returns that you're used to. And we change the conversation slightly, and we talk a little bit about how big should the stack be, right? How much stacking do you want? And stacking creates tracking error, right? It's not nearly as big as the tracking error that you get from selling those stocks and bonds outright and buying the alternative. But now you can get into a 20 or 30% stack on top of your portfolio. So instead of going from a 50-30-20, you go to a 60-40-20. That portfolio has lower drawdowns, has higher returns, has a higher Sharpe ratio, and actually has lower annualized standard deviation. That is important. And it has tracking error that's around 2%. So, you're going to be plus or minus 2% of the S&P any given year. That's livable. And your drawdown is substantially less. Is the drawdown zero? No. If the markets go down 50%, you got a 20% overlay, you're going to go down 35. But that's a lot less than 50. And so the more that you want to stack, the more you're going to experience tracking error from a year-to-year basis. So there's a trade-off, and that trade-off is something that the advisors like yourself have to think through with the client, because in order for you to have success with the client, you have to keep the client. And so if the client is very highly sensitive to the tracking error, i.e., I'm not doing as good as my friends are doing. My friends are all in the S&P or the NASDAQ, and I'm not doing as good. I don't like it. Well, that's when you get changed. So let's build a portfolio where we're tracking the thing that you're sensitive to, but we've also built in some brakes and some shock absorbers so that when the inevitable corrections happen, we've got some stuff built into the portfolio that can help you survive those periods of drawdown.
Phew, that's a mouthful. Yeah, these are all valid points, and I mean, I think at the end of the day, I'll fall back on the advisor in their role because we sit on a committee through the firm we're licensed with, and we interact with other advisors, and a lot of them are still using the same filters to get to the best value, the best cost fund, and I mean, you put those kind of parameters on it, and it seems to me just kind of tired, and you're missing out on a lot. And I think I'll just say it for Amy and I, she was the one that was the first one to utter, we don't know in a meeting. Which, for me in the time I've been in it, you never say that, I mean, but it's true. You said it, and then all of a sudden you realize what freedom when all of a sudden you can embrace the fact that this is more uncertain than ever because, what worked, I'm in the camp that, to rely on old correlations and all that stuff is fraught with peril. And so, but to accept, the fact that, I mean, you described it perfectly. There isn't one really certain aspect of the economy in the world right now. I mean, everything's in a flux. How do you invest for that? How do you invest for that and still keep your money protected and in a way where you're not selling into a loss? That's probably the one. If I've seen anything that was ultimately detrimental to a person's well-being financially, was one situation back in 0809, and there were a lot of bad decisions that preceded that for this particular person, not saving enough, too aggressive of a portfolio, and planning on working a certain time. And as I mean, we all know, life, the wind shifts. And this person couldn't work long and had an injury, and then the market crashed and still had debt to pay. And, you like you said, you got a 50% drop in the S&P, and then you're dumping out another 5% annually on top of that. You can't you can't dig out of that hole. So I think, we've gotten to a place where, and this sounds extreme, where we're more comfortable explaining to that kind of person, the retiree, we'd rather explain off a 6 to 8% rate of return in an S&P 500 20% environment versus the 40% loss when the market's down 50. And, we accept it. There's clients that aren't going to want that, that's not a philosophy that aligns with, but there are a lot of people that do, that see the risks. Maybe they can't articulate them as well as others, but they understand that going forward, doing the same old thing is really dangerous.
Yeah. And the other funny thing I find amusing to some degree is the focus on stock picking. Like, I'm going to make it up all on stock picking. And we know how hard that is. Not to say it's impossible, but it's hard. And if you're successful at it, you're looking at, creating excess returns of 50 basis points to 1% in the long term. Whereas if you stack a return stream like trend following, we've got the CTA trend following index from SocGen. We can go back and look at this. But you stack that on top of your portfolio, and we're not talking about a full stack, not having 100 cents in the dollar. Just if you stack 20% on top of your portfolio, you're going to get sort of excess returns in the 2 to 3% range. And they're not contingent on you finding the best stock picker or being the best stock picker. They're sort of structural. You have this, if you do trend following across all of these assets, across all of this time, you've got a return stream. You have to cover the cost of borrowing. But once you do that, a 20% stack can add 2 to 3% of excess returns compared to you trying to find the best stock pickers. And if you find them, they're going to give you 50 basis points to 100 basis points of excess return. So it's harder to find, it pays less, and it doesn't give you those moments where you're in heavy drawdown and you have this thing that can actually contribute to the portfolio when there's blood in the streets.
Yeah, no. Hey, listen, I really appreciate your time. These conversations are really helpful, and I know clients will find it the same. And for me personally, talking to people like you, it's always very affirming of what we're doing on our end because, again, we hear from different wholesalers from time to time that, we're I mean, it's a compliment. I'm grateful for it, but we're a lot more open to these kinds of ideas than the typical average person out there. And anyhow, so talking to you, it just reaffirms that, yeah, we've made the right decision, and we've put our flag on the right mountain, so to speak, in terms of what our lines are and how we work with people. So I just want to, thank you, Mike. Thanks for coming back on and joining me on Upthinking Finance today.
I appreciate it. And if you need more evidence of the efficacy, you don't have to go any further than Jonathan Glidden, who turned around Delta's pension plan, and he did it all via strategies like this portable alpha strategy. Pensions realized that part of the assets they had, those large cap US stocks, weren't passive assets. They were balance sheet assets, and they could use those for collateral. That's what he did. And it absolutely went from the Delta pension plan being underfunded to fully funded, using, basically the strategy that we've been talking about today, this portable alpha or return stacking strategy. So it's not just you as an advisor on the cutting edge of this. This has been a predominant strategy in institutions for decades. And so you should also take comfort in that this does work over time.
And you reminded me last point. Thanks for that little tidbit before we end. That's good. I'll look up it because I wasn't familiar with that. But the other thing is too, there was a time back in the late 90s, I remember I'd read the Wall Street and you'd see these ads, private client group, $1 million minimum net worth. And, $1 million is a lot of money, but it was a hell of a lot of money, 27 years ago.
Exactly.
And, now that's the beauty of it. Clients for a very low minimum get access to this kind of sophisticated asset management. So, yeah, that's a great point. I'm glad you brought that up. Anyhow, Mike, thank you so much. Just keep up the great work, and thanks for your time today. I appreciate you.
Thanks for having me, Emerson. Always a pleasure.
Emerson Fersch is a registered representative with and securities offered through LPL Financial, member FINRA, SIPC. Advisor services offered through LPL Financial, a registered investment advisor and separate entity from Capital Investment Advisors. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The guest speakers and the companies they represent are not affiliated with or endorsed by LPL Financial or Capital Investment Advisors. Individual tax and legal matters should be discussed with your tax or legal expert. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.